So Jim Collins said in his book, Great by Choice, fire bullets and then fire cannonballs. So what does that mean? It means that when you are trying to achieve growth, initial growth can be achieved maybe perhaps by copying others, but after that, you can only achieve growth through experimentation and scaling. So in this video, I want to talk about how you can budget to learn investing by trial and error without a mentor. I'm here to help you to create a plan for failure. And you might be wondering, that's kind of a weird topic. Like, why the hell would anyone want to learn how to plan for failure? And if you have been investing for a little while by yourself and you realize that investing is kind of like gambling, you'll realize how risky investing is. That is really because you don't have an investing strategy yet. Right now, you're still in the exploration phase. So if you're watching this video because I recommended you to go here, right now you are in the exploration phase, and I want to help you budget for failure. And it's important because if you think investing is a walk in the park, at the moment you go out and you register for an account and you will make money immediately, then you're going to be in it for a ride. And it's so important to learn how to budget for a failure so then you can get through this phase as quickly as you possibly can. Because the longer you stay in this phase, the more money you will lose and the less profitable you are. And what you're really trying to achieve here is an extraordinary result. You're trying to get a gain that is higher than the market. So you can't do that by doing something normal. You need to do something abnormal to get abnormal results. I'm trying to help you prepare for this process because you're about to go on this alone without a mentor. Without a mentor, you'll encounter basically every single problem you would encounter. So you need to solve every single problem yourself. It is a difficult journey, but I know why some people would want to go down that path, and which is why I'm taking the time to make this video. It's not going to go viral, but that's not what it is about. So first, let's start with why we need to do this, shall we? So first, let's talk about experimentation. And when you think about experimentation, it's kind of weird in an investing context. So it is easily best understood if you look at great companies. Now, one of the great companies is SpaceX, which is run by Elon Musk. As of the time I'm recording this video, he's actually testing Starship, a new type of rocket that can basically fly and then land with people in it. This has never been done before, so Elon Musk needs to prepare for failure. So as of the time I'm recording this video, Starship has already blown up 9 times. So that means the rocket flew, it came back down, and then it blew up. 9 times already. And in the 10th time, it actually successfully landed without blowing up. And that is really planning for failure. Because once you're able to land that Starship successfully without blowing up, then guess what? You can land it over and over and over again. And that's actually how the previous thrusters in SpaceX works. Once you have a working model, you're in a good shape. But you need to plan for failure to get to that point, and that's where you are now. The next example is Amazon, and I actually searched this statistics online because great companies run experiments all the time, and the more experiments you run, the better you become. So for Amazon, they run an average of 2,000 experiments a year. So to me, this number is actually a little bit low. If that is what the number is, then that's great. And when you think about it, there are 365 days in a year. There are 200 working days or so in a year. And that means they're running 10 experiments per day on average. And if they're able to double or even triple that number, then they'll grow a lot faster. The next one is Google. And Google is very famous for the concept of A/B testing, which I'll explain in a bit. And they are running 7,000 experiments a year. So as you can imagine, the data they're collecting, trying to optimize their algorithm and their product and service offerings will feed back into a better system, a better business, so then they're more and more profitable. The next one is Procter & Gamble. It is really a consumer brand. You probably know what it is. And they run 7,000 to 10,000 experiments per year. So when you think about that, wow, that's actually a lot of experiments they're running because they're a consumer brand. So they're able to do that, and they're basically in presence in a lot of countries. That is really just a glimpse of the scale of experiments that big corporations are running. And if you're looking to invest, if you're looking to grow, if you're looking to achieve extraordinary results, then you should be running experiments as well. You might not run 1,000 experiments, but you should at least budget for 100 or a couple hundred, so then you get to that point where you're earning the return you're looking for. I want to take a minute to talk about the Apple development process. And I think this is actually quite important because Apple doesn't launch a lot of products. So how can they run experiments? And if you read a lot of books about Apple, like Insanely Simple and whatnot, then you'll realize that they do a lot of experiments in-house before ever launching a product. So for every phone that they create, they'll have 4 to 5 different versions that are really good prototypes, so then they can select the best one. For every phone case, phone shape that develop, they'll have 5 to 10 different variations, so then the design team can choose the best one. And they keep doing that process, so then they get to the best phone possible. In my opinion, that's why an Apple phone is so expensive, because they took the time to optimize the entire system. So even though the production costs of an Apple phone might only be 1/3 or 20% of the phone cost, the design thinking process and the iterations they have gone through makes the user experience a lot better. So when you think about investing, during the exploration phase, when I was discovering what strategy works best for me, I placed around 3,000 live trades in total. And I also tested a lot of different strategies using the computer. I think I tested over 300 strategies, including all the parameters. That is what enabled me to achieve 30% a year. So that is really my vision for myself, and my portfolio goal is to make 30% a year. So if you're interested in learning more about investing and Investing Accelerator, which is the coaching program I offer, then you can go down to the link below and register for the free case study. And then after you watch the 4-hour webinar, then you can schedule a call with me and I'll see if you're a good fit for the program. If you are, then you can be part of the community. And this month, I'm looking to help 20 full-time professionals without a financial background to master investing. The stretch goal is 30 people. So if you want to get the free training, then just go down below to where the description is. Click show more. And then below that, you'll find one of the first links is the free webinar, how to get 30% from the stock market in the next 12 months. So click on this link, and then afterwards, you can read through what you'll get in the webinar. And then you can write down your name and your email address and click watch now. Then you will be brought to the webinar, so then you can start watching it. In Investing Accelerator, we have some new case studies. Avinash made 48% from CAE in 42 days and 72% from Chef in 6 months. Adrian made 38% from AXP in 1 week. And Heywan made 33% from Altrix in 8 days. So all these are very amazing, successful case studies, and congratulations to you three. So after going through this iterative process, I'm able to come out with a strategy I put in Investing Accelerator. This is where I want to introduce you to the concept of A/B testing. So A/B testing is really common if you're working in front end as a programmer or web development, you're just in the general programming space. You probably have heard of this term. And basically what you would do is you would take a very small part of the process, let's say the front page of your website, and you would make a variation of it. And if you have 100 people going to your website, 50 of them will see the first version, and another 50 of them will see the second version. So that is A/B testing. And then you'll test it against a goal, like the number of visitors that click to the next page, the number of visitors that give you the email address. So then you see which one performed better, and then you would keep that one. And then you would run another A/B test, and you would test the first version against the second version again, and then select the winner, and create another A/B test, select the winner, create another A/B test, select the winner. So over time, your front page or whatever you're testing will become better and better and better. And this is actually a very powerful process. And when you think about evolution and how nature produced more and more sophisticated animals, it is actually the same process. So you have a population of animals, and some of them are stronger, some of them are weaker. Naturally, the weak one dies out, and the stronger one will become more and more populated until a new trait gets developed. Let's say for giraffe, the neck is longer so that they can eat the leaves above the trees. Over time, longer and longer neck giraffes will be able to survive better, so then the population of longer neck giraffes will grow, and that's why giraffes have such long necks. That is really the process of A/B testing, and it is basically the process of evolution. When you think about extraordinary growth. When you're thinking about achieving more than what the market return is, if it is 10% and you want to achieve 20, then you need to go through this process, especially if you don't have a mentor. So let's talk about how you can do that in an investing context. So first of all, you need the tool. So you need a testing software. Technically, you can pull this off with just a chart alone and without any programming skill. But if you learn programming, it will make your life so much easier. So if you are an engineer watching this video, then good job, because you already have a head start and you can just buy the data, buy the testing software, so then you can start testing. But if you don't have a programming background and just want to do it the grassroots way, just scroll the chart back maybe a couple of years and then from candle to candle start going from there. And at least you can still collect data. You can do it manually, but it will still be a lot faster than live paper trading. Okay, so make sure you don't ever go down the live paper trading route. It's just a waste of time. Step 2, keep a very simple exit strategy to start. Because if you have to choose between optimizing your entry or exit, you need to optimize your entry first. Just because you have a good entry doesn't mean you'll be profitable. Because if your exit is shit, you'll still lose money. Keep a very simple exit strategy first. Maybe you want to set a goal of 20%, 30%, or maybe if a certain candlestick pattern happens, then you exit. But keep it very simple and focus on your entry first. This will make your life easier because if you change both variables at the same time, it's going to be hard to keep track of what makes it successful, and we'll come back to exit at a later step. So now you're down to the entry mechanism. And out of all the parameters that you can optimize for, the easiest one is technical analysis. Now, when you're going through this phase, you need to understand that technical analysis is not complete. I have tested many strategies. The max you can get with technical analysis is like 60% win rate with a given exit strategy. If you are able to get to a 60% win rate, more than 50, then I think you're already doing a pretty good job with technical and move on to the next step. And when you're looking at technical analysis, you want to first start with one indicator. So you want to first start with one indicator and figure out what is true about that indicator. Do you buy when the EMA crosses over to each other? Do you buy when the price crosses over the EMA? Do you buy when the MACD is doing a specific thing like a crossover? Or the momentum is changing, or is increasing consecutively for 3 candles? You need to define that condition and then test that. And you need to start with one indicator and achieve some level of success. And it doesn't need to be 100% win rates because you're not going to get there with one indicator alone. And then afterwards, once you get comfortable with that one indicator and you know what works and what doesn't, then you add on to your second indicator. And again, you run through the process. And here I actually wrote down test your parameters for your first and second indicator. And what that really means is that you should test different scale of your indicator. So let's say you're using an EMA, which stands for exponential moving average. And in this case, you can choose between a 10-day or 10-week or 10-minute exponential moving average, and then 20, 50, 100, 200, 500, 1,000. So you would want to test through all of them and test different entry criteria and see how the profitability changes. So once you have tested that, then you probably know what the optimized parameters are, which allows you to move on to the next stage. So now you have gotten technical analysis down, and you want to combine that with fundamentals. Now for fundamentals, it is a little bit tricky because it is very easy to fall into the hindsight analysis, because right now you will get access to all the fundamentals. So if you scroll back 3 years, you actually know what the 3 years financials are, but today you don't know what the financials 3 years from now are. So in a sense, yes, you can use fundamentals, but it's a little bit more tricky. But you basically follow the same process, go through fundamental analysis, so then you figure out what works and what doesn't. And I find that a lot of people will struggle with this process because you don't have an accounting background or you don't know finance, but it is extremely crucial that you go through this process. Because if you skip the fundamental analysis, then what you end up with are fundamentally bad companies, which are not profitable, they don't have a product, the company might go bankrupt, and you wouldn't be able to pick it up with technical analysis. So that is really where the problem is. So make sure you include fundamental analysis. Now, once you have that down, the next step is really trying out different risk management strategy. Now, there are many risk management strategies on the internet. I'm quite sure you can search that up and you'll find a ton of them. This can range from using stop losses, different kind of stop losses like trailing stop, just a regular stop, when you should move your stop loss higher, should you use options, how to use options to manage risk. And that is such a complicated topic, it wouldn't be covered here, but you definitely need to explore different risk management strategies. And I can tell you what you will find so then you know what you look for and whether you're heading in the right direction. Now, sometimes when you're using risk management strategies, it will actually make or break your strategy. So if you set a very tight risk management strategy, it can actually end up making your strategy unprofitable. So that's what you got to test out. And each stock has their own kind of comfort zone in terms of risk. For certain stocks, you might be able to set a very tight risk management, but for some other stocks, you might need to be more relaxing. So you got to take that into account as well when you're testing your first two indicators. So as you can see, it is a little bit of work. Ultimately, that will allow you to achieve level of success that is much greater than whatever the market is giving you, which is a 10% per year. Now, the next step is really to combine that with different profit-taking strategy. Now, in this case, I'm really talking about the exit strategies in step 2. Now, previously, you might have set a simple one like maybe 20, 30% or 50%, then you take profits. And now you're really changing that parameter because you got your entry, you got your risk management, you got your fundamental analysis. So now you're changing your profits. And when you're testing, you're not really giving yourself a lot of flexibility in terms of exits because in step 2, it was a very rigid, simple, target exits. But as you become more sophisticated and you study more exit strategy, then you can give yourself more flexibility. So based on my experience, you would want to have a couple of techniques combined together with a target. And just because the stock reaches a target, it doesn't mean you need to exit everything at once or just exit. I think it also needs to depend on the situation. And you need to analyze the other variables as well. And again, testing this part alone will change the profitability of your strategy greatly. Because if you set a target that is too aggressive, let's say I want 50%, but it takes forever for the stock to get there, your turnover, which is the time in which you invest and then you take a profit, will be too long. You will be stuck waiting forever and ever and ever, and you never take a profit. If you set a target that is too conservative, then you're leaving a lot of money on the table. So basically what you're trying to achieve here is a balance between taking profits and holding onto the company that is great for a long period of time. So number 9 is really different kinds of profit multiplication strategy. Now this one is very advanced and I suspect most people are probably going to skip this step. But if you want to achieve an extraordinary result, like 30% per year, then you probably need to dive into this and spend a little bit of time on how different scenarios will play out. It is so important for you to test this part because as you become more aggressive when you're investing and you're becoming more confident, certain bad events can actually impact your portfolio significantly. And that's why you need to go through this phase to make sure your portfolio doesn't blow up while kind of stepping on the gas pedal to go faster. And that's what really profit multiplication is all about. Now, there are many different ways to do this. Some people use options, which is what I do. Some people use margin. Some people use futures, swaps, or whatever you call it. But there are different ways to basically multiply your profit. And all these are advanced concepts. And when it comes to using margin, it is quite dangerous as well. I'm sure you will find a lot of horror stories on the internet saying how people lost millions or billions of dollars using these advanced strategies. And this usually comes down to not truly understanding how it works, not truly understanding the downside risk or what a margin call is, and not being prepared to protect yourself from these remote but likely possibilities. So that's why you need to test it, because you need to test how far you can take your strategy, let's say with margin, with options, and the strategy will stay intact and not break. Because if it breaks, you better find out when you're testing instead of finding out in real life. Because it is so easy to lose 5, 10, 20, 30,000 in the stock market just like that. I've met people that have lost 50K. I've met people that have lost 200K. I have met people that have lost 400K. So that means you need to know what you're doing before you start doing it. And that's kind of a paradox. And the only way to know that is through testing without real money. if you are going down the route without a mentor, because of course a mentor will solve all of those problems for you if he's a good one. The 10th step is really to adjust for diversification. There are two schools of thought in the market. One is you should be very diversified. And that will basically lead you to investing in S&P 500 because you'll end up believing in the dogma of investing in S&P 500 is the safest because you're protecting from all risk except when S&P 500 is going down. That is really on one end of the extreme, so you can think of this like a political spectrum. So the other side is really you don't diversify at all and you go all in. And you usually encounter this kind of people. They don't have a lot of capital, they couldn't really diversify, and they had to go all in. And they had so much confidence that this is the stock that will bring them to millions. So they will go all in on that stock and end up burning themselves. Because even when you're looking at some of the best world-class investing strategies, their win rate is only 80, 90, perhaps 95%. And when you think about that, how is it someone can go all in on something that is not 100% win? Well, that is poor risk management. So you want to achieve sufficient diversification, and there's actually a mathematical formula to that, and not doing a lot of work. Because obviously, if you invest in 10 companies versus 100 versus 1,000, investing in 1,000 companies requires a lot of work. But if you invest only like 10 companies, then hey, that's actually not a lot of work. So when you think about what I do, I invest in 10. Most of the time, less than 10 companies. But I have seen people investing in 50, 100, and each of them, they would do research. And if their research process is not efficient, it's taking them a day to pick a company, that is 100 days. And when you think about 100 days, you're pretty much doing this full time or half full time, which means it just doesn't make sense from a time to reward perspective when it comes to investing, because you want your money to work for you, not you working for your money. So that is really the key difference, especially if you are a full-time professional. So the next step, the 11th step, is really to streamline your process, and you want to automate as much as possible. And if you have been following the previous 10 steps I have laid out for you, then you should be at a pretty good shape. You would have either programmed your entry, you would have either did some sort of stock screening to narrow down the list very quickly so then you have the great opportunities. You know exactly what the target exit is, and you should be able to automate a lot of that. If you are able to achieve somewhere of around 1 hour to 2 hours a week when it comes to long-term investing, then I would consider that to be pretty amazing. Now, for myself, I spend around 1 to 2 hours a week on investing, and on average, I just spend around 5 minutes to 10 minutes a day just to take a look at the market to see what it is doing. For me, it is more like a passion. I also educate and help a lot of students, which is why I spend more time than that, basically answering their questions and looking at other stocks that I'm not investing in. But if you are just managing your own portfolio, trying to get to financial freedom, then I think 1 to 2 hours per week is more than enough. So once you streamline your process, that is the time you're aiming for. If you are spending 20 to 30 hours a week and you are long-term investing, then you're doing something wrong. Because for day trading, they only spend around 20, 40 hours a week. That's kind of the range. So you're basically spending as much time as someone who's day trading. So you need to evaluate that. And finally, once you have profitability, probability, and the right expectation, then you can use real money to invest. So wow, look at this process. Look at the steps that I told you to go through. It's a heckload of work, isn't it? You need to trust me that you need to go through this process, because when I was a kid, a lot of people think I'm young, I skipped this entire process and I end up losing thousands of dollars. So there is a reason why a seasoned investor tells you to test your strategy. There is a reason why you need to go through all the steps. And if you go through all these steps, then you actually left no stone unturned. And that is very important, because when you're looking at your own strategy, you're going without a mentor, you need to leave no stone unturned. Is it time consuming? Yes. Is it excessive? Yes. Is it troublesome? Yes. Should you go without a mentor? Well, you're watching this video, so I suppose that's what you're doing. Do you want to risk your money without a solid strategy? No. So when you think about that, it is so important to test out the whole thing, because the last thing you want is after investing for 3, 6, 9 months, and one day all your gains just got wiped out because you didn't plan for, let's say, step number 7, risk management. Let's say you have been investing for 3, 6, 9 months, and one day there's a technology correction and wiped out half your portfolio because you didn't learn fundamental analysis. So you can think of investing, most of the time it works until the time bomb blows up. When you're looking at your investing strategy, you need to know where the hole is. And basically, you have a bucket and you're trying to pour some water into that bucket, and you need to know where it is leaking. And you best find that out before you start losing real money. If you decide to go down the path of trial and error, which is difficult path, it is possible. I have done it before. I have seen other people done it before. I think the probability of success is 1 to 1,000, but don't worry about that. Just keep going, because if you're watching this video and I recommended you to watch it, then I do believe you can do it. So while you're still here, I want to share 2 more stories with you, which is about my personal experience when I was doing Forex, which is foreign currency, and that was many years ago. I was investing a very small sum of money. Nevertheless, it was still real money because I was a little bit arrogant. I didn't think I have to go through any of these steps I laid out here. And I went ahead and I started playing with $500. Now, of course, when you think about $500, hey, that's not a lot of money, no big deal. If I lose, I'll start over again. And that's exactly the wrong mentality, but nevertheless, that's what I did. For some odd reason, the strategies I was using that time just worked. And within 3 to 5 days, I doubled my account. I went from 500 to 1,000. I was like, holy cow, it worked. I hit the jackpot. So then within the next day or two, I put in another $1,000. I used my strategy to trade for another 1 to 2 weeks, and boom, I'm at $4,000. And then afterwards, I was like, oh my God, I'm going to put in more money. So I get to like 6,000 to 7,000 or whatnot. And then my accounts jumped to 10,000. And I was like, wow, oh my God, this is working. And then it jumped to 20,000 at one point, and I was, holy cow, I might be able to take it to $100,000. And I was just so excited. And I think during that time, I wasn't even looking at news, so I don't know what was happening in the market, but I was just making money, so I didn't care. At that point, my account suddenly started going against me, and I started losing money. And during that time, there was a lot of volatility in the markets. I think there was some weird thing going on. It might not be Brexit, but something similar to Brexit was happening, and the currency market was moving a lot. So I was trading, and I was actually staying up all night till 2, 3 a.m. just looking at the market. And then afterwards, my account went from 20,000 to 10,000. And I was like, okay. Let's try to see if we can get it back to 20,000 because I've done it before. My strategy must be working. And I start getting emotional, and boom, my account went to 5,000. And I start getting more emotional, and I was like, screw it. I'm just going to keep trading. Like in the next 2, 3 hours, I'm just going to keep going at it using my techniques or whatever I know how. And then 5,000 went down to 4,000, to 3,000, 2,000, 1,000. And I think at the end of the day, I got so emotional trading, my account was negative $200. And you might be wondering, how do you get $200? And that was because I think throughout the process, I got margin called a few times. It's a bit more complicated, but basically I was able to lose a little bit more money than what I had, and the broker actually had to sell my position at a loss, so I owed the broker $200 in the end. In the span of 2 months, approximately, I was able to take my accounts from 500 to 20,000 all the way back down to negative 200. And that was because I was day trading. Of course, I wasn't getting a lot of sleep because initially I was getting really hyped for making a lot of money, and I was getting really hyped for losing a lot of money. I don't have any testing whatsoever. I have no risk management strategy, which is expected from a young kid. I have a mess in terms of profit-taking strategy, and I actually don't think my strategy even worked. I don't even think I had a proper strategy when you think about it. My profit multiplication strategy was a mess. I was just using margin as much as possible until my account blows up. And guess what? It did blow up. So that was a very painful lesson. Even though I just started with 500, it was a very memorable learning experience because back then 500 was a lot to me. And you need to remember that is not my first 500. That was like my 10th or 15th 500. And because I've been doing this many times, I didn't follow the steps I have laid out here for you. Initially, after using demo trading for 1 month, I thought, oh my God, this is so boring. I might as well just put real money in. So I just started testing with real money, which turns out to be a complete disaster. So when you think about that and the process I go through and the pain I had to go through, I'm trying to help you visualize it before it happens to you so then you can avoid the loss. Because the last thing I want is for you to come to me and say, hey, Eric, I've been losing thousands of dollars. Can you help me fix it? Which to a certain degree I can, but the best way to prevent you from losing money is to have the right knowledge to start. And if you don't have the right knowledge, then you need to get it through trial and error. And the best way to do trial and error is through testing, because it doesn't cost you that much money. And you get to figure it out whether what you believe to be true is true very quickly. And that is really what the big corporations do. That's what I do. And so far, from reading a ton of books to joining courses to testing myself, I think I find the most growth testing myself without a mentor. Because having a mentor will actually solve all of these problems for you. Because as you can imagine, if you start off with a different entry mechanism, that actually influences all the steps you have behind it. And if you have a very good entry mechanism, if you enter a certain way, and if you develop your philosophy a certain way, then your exit, profit multiplication, fundamental analysis, they all change and they all need to work together. So that's why I have structured the steps this way to basically help you fail faster, help you fail better, and help you fail in the least costly method possible. And let me tell you another story. So I promised you 2 stories. So this is the second one. So when you're looking at my investing journey, I have been investing for over 12, 13 years now. And I actually took a large chunk of my time to become profitable. The time it took me to figure out a strategy was actually more than the time it took me to become, let's say, quote unquote, wealthy. I don't actually think that is the right word, to grow my account. That's probably the more accurate word. Within 12 years, I used 8 years for testing. And this seems very excessive. And that is really because I didn't have a very efficient process until later. Like I didn't figure out all these 12 steps initially. I had to figure it out myself and then go through these steps and then become profitable. So that took me 8 years. So now you know this probably will take you 2, 3, 4 years, maybe half that time, because you're smart and you're smarter than me. So after testing 8 years, I have been investing and using this strategy for a little bit over 5 years now. So far, my return on average is approximately 50% per year. And this is actually exceeding my target because in the beginning of the video, I said that my average return is around 30% return a year, and I'm getting 50% per year. So that is great. And when you think about it, my strategy for the last 5 years actually did not change at all. Because once you figure out what works and you have a complete understanding on why the strategy works, when it doesn't work, exactly in which situation you need to apply it, and how do you deal with all the little special situations in the stock market, because there are always special situations, you just keep doing the same thing over and over and over again until you reach a very high return. So I'm just taking a look at my account here as of today, and my total return over 5 years and let's say a half, it's around 900%. And what is surprising to me, or a lot of people in this case, is that during this 13 years, I spent 8 years testing. So it is so important to figure out what that strategy it is for you. And if you have come to this video, it means you have decided to go down this path of trial and error. And I can confidently tell you that you can make it. I have seen people trial and error and achieve a great return, achieve a great strategy. And then afterwards, for the next 5 years, once you have figured out your strategy, it's just doing the same thing over and over again. I think for the last 5 years, regardless if there's an oil price crash, regardless if there's a trade war, regardless if there's COVID, regardless if there's a tech correction, my strategy actually works out pretty well. And that's how I get to 900%, which is approximately 50% per year. So when you think about that, there is light at the end of the tunnel, per se, and you are able to get there once you arrive at something that works. What's important then, you can think of your journey like a dip. You need to go through the dip and figure out everything that works and everything that does not work, and cut everything that it doesn't work out. Now, it sounds very simple, but it's actually a lot of hard work, because how do you figure out something works or not? And you can only do it by testing it. And you need to do this really fast, because if you are planning to be a long-term investor like myself, investing long-term can mean you're holding onto the stock 1 year. So if you have one idea and you use real-life testing, you need to wait 1 year to find out whether something works or not. And that's simply not feasible, because you only live for 100 years. So that means you only run 100 experiments. But as you can see, I ran and tested 300 different strategies. I placed 3,000 trades. So how do you get that kind of volume when long-term investing requires low volume? So I think that is really one of the paradox when it comes to investing, business, and life as well. And with the help of computers, you can do a lot of testing very quickly using historical data. And I think that is probably the best way to achieve profitability without a mentor. So then now you are ready to budget for it. I think at this point, what's important is really for you to take a step back and have a think what you can do to budget for failure. Because you decide to go down the trial and error path. You decide to go down the path of discovering investing yourself, whether it is because you don't want to pay for education, whether it is because you haven't found the right mentor yet, which is fine. But either way, if you decide to invest in yourself because, maybe you're unemployed, or you got some inheritance money, or for some odd reason you sold a house and you have some money and you want to put it in the share markets, you want to minimize the loss of trial and error until you have a very solid strategy. Now, of course, if you're able to find a trustworthy mentor, if you're able to have this person to ask questions and basically help you solve a lot of roadblocks ahead of time before you even click the buy button, it will actually give you a fantastic chance to succeed. Because even with a great mentor, it doesn't mean you'll succeed 100% of the time, but it will greatly tilt the odds in your favor. One great example is really Michael Jordan. Michael Jordan is a great basketball player. But do you think he has a coach? And the answer is, of course, he does. And everyone knows he does have a coach. But the question is, if Michael Jordan is such a great player, why does he need a coach? And the answer is, well, you need discipline, you need that third-party view, and you need someone to do a lot of the administrative work and thinking and planning for you, so then you can become that great player, so you can achieve that result you're looking for. And even for professionals like Michael Jordan playing basketball, or Michael Jordan's team when Michael Jordan is a coach, they all help. And that's really the power of a mentor and a coach. And I think eventually in some part of your life, you will run into the mentor that is right for you. You'll run into a mentor that is the right fit for you, because everyone has a different philosophy when it comes to investing, and everyone has a different view on what it means to be investing in the market. And if you want to achieve extraordinary results, you need some sort of catalyst. And the catalyst can either be you do the testing yourself, which a lot of people get that thrill from figuring it out yourself, which I kind of do, or you get a coach and it helps you accelerate that process, which I also very enjoy, because I think the times where I got coaching, it just helps me understand the way the world works much better. I guess this is another important video, and if I recommended you to this video, then I must think you need to listen to what I had to say here. So best of luck. I look forward to see you in the next video. And in the next video, I'm actually going to dive into another tax topic, which is how capital gains from Canadian corporations are taxed. And this is actually a follow-up video to my previous video about capital gain tax in US and Canada on a personal level, because when you're looking to invest, inevitably you will come across the concept of investing using a corporation, because once you achieve a certain level of wealth, you will be thinking, is there a more tax efficient method to invest in the markets and basically not get taxed. We'll dive into this topic in the next video, so I'll see you in the next one.